Everyone thinks governments control their own money. They're wrong, central banks do. When a nation needs to borrow, it doesn't walk into a bank with a loan application. Instead, it issues bonds, IOUs that promise to repay with interest. Those bonds sit in the financial system, waiting for buyers. But here's the mechanism most people miss. The central bank stands behind every transaction, with the power to make borrowing cheap or expensive by controlling the interest rate itself. Take the 1980s. The Federal Reserve, led by Paul Volcker, deliberately raised interest rates to historic levels, over 20%. The goal was brutal and clear: crush inflation by making borrowing so painful that people and businesses stopped spending. Government debt became harder to service overnight. The leverage was invisible, but absolute. But the central bank's power works the other way too. When economies collapse, central banks lower rates towards zero, making government debt cheaper to issue and refinance. They can even buy that debt directly, a practice called quantitative easing. They're not lending money in the traditional sense. They're creating it electronically and trading it for bonds. The national debt stays on the books, but its effective cost drops. Here's the irony those officials in the 1980s didn't fully grasp yet. High rates that crushed inflation also meant the government's own debt service costs skyrocketed. Volcker was solving one crisis while creating fiscal pressure that would echo for years. That tension between controlling inflation and managing debt has never really gone away. The central bank also sets reserve requirements: how much cash banks must hold instead of lend out. Lower reserves mean more money flows into the economy. Higher reserves tighten the spigot. It's not flashy, but it's hydraulic. Credit expands or contracts based on these levers, and national debt expands or contracts with it. So when you hear that a country's debt is unsustainable, what's really being debated is whether the central bank can keep rates low enough to service it. The debt itself doesn't disappear. The central bank's decisions do. And those decisions ripple into your mortgage rate, your savings account, and the price of everything you buy. Understanding this system isn't about predicting what happens next. It's about recognizing that credit and national debt aren't forces of nature. They are engineered outcomes. Central banks are the engineers. That's the exhibit we're standing in front of. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to see how these levers have shaped lending, credit, and debt across centuries. There's a new system breakdown every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.